Okay, sounds good. Thank you guys for joining us. How many people are in here? Um,
We
there's a
got
few
six
people in here.
or seven.
Yeah. So thank you guys for taking time out of your day to join this presentation. It's probably not going to be like the most exciting thing. You might not learn too much. You might learn a lot, but just thanks for showing up. A little bit about me. I don't know if Simon talked at all, but so I'm from Las Vegas. Went to Stanford, studied management science and engineering there. So basically, like a fancy business degree. And then now I currently play in the Dodgers organization. And because of COVID, I started looking for work and stumbled upon this job with Raymond James. Got my certifications as a financial advisor. And now I'm doing financial advising and still playing baseball. So that's kind of where we're at right now. But in terms of this presentation, we're just going to go through and talk a little bit about some habits to become financially successful and just have like a lot more kind of like a better idea of like what your finances are doing and what you can do with the money that you're actually making. Um, so managing money is more complicated than you'd think. If it wasn't, as a financial advisor, I'd probably be out of a job. Well, what if I told you when you're young and starting out that there are some straightforward habits that you can adopt to make that task a whole lot easier? And that's really why I'm here today. It's to help hack your finances and set up future you for success through 7 habits. So we can get started. Go to the next slide. So the first habit is to invest in yourself. And if you don't believe it'll pay off, take another look at this chart. The bachelor's degree might help you out earn the high school diploma holder by $1 million over a lifetime. But college isn't the only path to maximizing your earnings potential. Any kind of training that can build a valuable skill set counts. And don't forget to negotiate your salary. Those who know their worth tend to get paid for it. So as minor league baseball players, we want to make sure that the dollars that we spend are good investments for our careers, whether that's in better training, better gear, or something else. You can go to the next slide. Invest in yourself, but don't let your college dream turn into a debt nightmare. Advisors like me can help you run a cost benefit analysis of your options before picking a college, and you can likely save tens of thousands of dollars. To offset tuition, find scholarships, paid internships, and other ways to cut costs. Calculate what your student loan payments will be using the government's repayment estimator and compare that with the average salaries in your chosen field. And look before you leap into a pile of debt. So as baseball players, we don't really, some of you guys might not really be focused on college and what's going to happen. Oh, this is the wrong slide. Okay, never mind. Sorry about that. Okay, habit 2, borrow responsibly. What does that mean? Only borrow what you can afford, only if you have to, and at the lowest interest rates available. You should analyze borrowing for any large purchase, such as a home. Does anyone here know why a car loan is classified as bad debt? You guys can put that in the chat if you know.
Would be because it's a depreciating asset.
Yeah, exactly. So it's because these types of loans usually come with a high interest rate and you're financing an asset that loses value quickly. Versus a home will typically either stay with the pace of inflation or gain value over time because of location or something else like that. Yeah, exactly. And then the next slide. Still more than 100 million Americans have car loans, according to the Federal Reserve. And if you don't want to pay $130 more a month for a car, as in the example here, pay attention to your credit score. Pay your bills and your debts on time, and check your credit report for errors periodically. Your credit score is your report card that lets people know how responsible you are with your money. And in the financial course, we will go into that in more detail. And then habit number 3, we really want to make sure that your money is going to work for you. So give it a specific job. To put habit 3 into practice, we track spending for a month to see where your money really goes. You can use a spreadsheet or a budgeting app that automatically aggregates your accounts. Then cut any phantom expenses like subscriptions you no longer need and start putting that money toward your short and long-term goals. Whether that's paying down high interest debt, saving for a down payment on a house, or planning for your retirement. According to the government's 2018 Consumer Expenditure Survey, the average 25 to 34-year-old spent $56,457 in 2018. So are you average or even above average here?
How many of you guys do use a financial planning app? And is there one that you guys use and prefer?
I'll go first, and Excel spreadsheet. So the two that I found that I use the most, so just to get a big picture of like what my finances are doing, I use an app called Clarity. And you can put all of your accounts into there, and it'll give you just like a big picture of like where your money's going. And it'll show you just like how much cash you have, how much credit card debt you have, and it gives you a pretty good idea of what you're spending each month. And then the most like in-depth one is definitely Mint. Mint is pretty good at giving you like a whole big picture idea, or like the details of each kind of place your money is going. So that's a pretty good place too. Okay, we can go to the next slide. Yeah. Okay, so I know that budgeting and keeping your expenses low doesn't sound fun and is sometimes pretty scary, but this isn't about self-denial. Instead, it's about intentionally directing your money to the things you value and actively cutting out things that you don't. So you have money to set aside for saving and investing. So don't think of keeping expenses low as a sacrifice, but think of it as the path to financial independence. Let me go to the next slide. And habit 4 is to start saving for retirement early, which I think is one of the main things that you guys wanted to talk about here. So usually in an employer-sponsored program like a 401k, when you're young, you have a long investing horizon for your money to compound, and that's a good thing. So basically, you have a lot more years to invest and for your money to make more money than say your parents do. So you've got time on your side.
I have a
Even if
question.
you don't, yeah.
Sorry, I wasn't sure if you wanted us to wait till the end of the presentation to ask anything or not.
Fire them up. No, fire them up.
I was curious, like, so us and I'm pretty sure we all have the minor league salary right now, not getting paid very much. So we're getting like just tiny bits put into this retirement account. Should we like? I think most of us probably at least have some kind of signing bonus. Should we be putting some of that money into a retirement account separate from, say, what our organization sets up for us, or should we just kind of trust that right now and keep that spending money on the side for other stuff?
Yeah. So what I saw my signing bonus as was kind of like something that was nice to have, but it wasn't necessarily for me today. And that was just because my situation is I didn't really have any expenses that I was going to have in the near term. So I used some of that money to buy like baseball related stuff, but a majority of that was put into investments. Like for example, I bought a house and put some money into the stock market, and that was kind of like, this is what my signing bonus is used for. But it really just depends on like what you're willing to take in terms of risk, because when you put money into a retirement account, that money is basically gone until you're 60 years old. So if it's money that you're okay with not spending in the next, 40 years, and like you're okay with that being basically gone, then you should put it into a retirement account. I think everyone, the earlier that you can start an IRA, is the better off you're going to be down the road. Because if you were to start an IRA today, say I'm 24 years old, so if I start an IRA today versus waiting even just 1 year till I'm 25, at like a 10% compounding interest rate over the next 40 years, that equates to about $800,000 missing of potential growth. And that's just investing $6,000 a year, which is the max you can do in an IRA. So if you can start today versus waiting until next year or waiting until 2 years down the road, you get to see like that money grow, even though it's such a little sacrifice like today. And that's kind of what you see here in that chart. You see Alyssa, she starts at 20 years old. And she ends up, how much is she saving here each month? Well, basically she contributes $540,000, and she's able to more than double what Matt did just waiting 10 years. And this is probably at a very like low interest rate, maybe 6 or 7%, which is pretty standard across like for the stock market at least. And you see, like, the longer you wait, the more you have to invest to
So
get to what other people had. Hmm.
so like I have a good amount of money saved, but it's not like a junior out of college or someone out of high school, top 4 rounds, like that
Yeah.
much money. So I would probably just go the investment route, like through my own stuff in the stock market rather than, because
Hmm.
I'm no shot. I'm contributing 12K annually to a
Yeah.
retirement fund, like in this example. But just out of curiosity, because I don't know if I could afford to go that route right now, how would I go about setting up a like Roth separate from the Rockies? Like, do I go to a bank and talk about setting one up? Because that's separate than just normal
Yeah.
stock investing, I think, right?
Yeah. So there's a couple ways that you can do it. If you wanted to make all of the investment decisions on your own, you can go to any brokerage site like TD Ameritrade, Charles Schwab, E-Trade, and set up, like, an IRA is basically just a designation for the account. So it's the same as any other, like, individual investment account. Like, if I'm sure some of you guys have heard of Robinhood, it's basically the same thing as Robinhood. Um, but really what's happening is how the money in that account is taxed. And that's what IRA is doing. So you can do that. You can go individually, go to like TD Ameritrade, Charles Schwab, E-Trade. I would recommend TD Ameritrade. They're pretty good if you're going to do it on your own. The other way you can do it, you can also go to your bank. Your bank will be able to set you up with one. And then the third way is like financial advisor. So like myself, like I open up Roth IRAs and traditional IRAs for people. I help them make the investment decisions. I educate you guys on, like, this is where your money's going. This is what you're actually buying. This is what's going to happen over the next 40 years. And we try to make a plan for that. That's probably the most hands-on. Like, so on this side of the spectrum is like TD Ameritrade, you're doing all of it on your own. Then on this side is like you have a financial advisor like myself. So you're getting a lot more guidance, a lot more hand holding over here, versus on this side, you're kind of on your own, making the decisions.
Cool. Thank you.
Yeah. Any other questions, or we can get back to this? But yeah, so my message to you guys is just to start investing as early as possible for your retirement, even if it's just a small amount, and let the power of compounding work for you. And as a baseball player, like, your signing bonus can be a huge jumpstart to financial independence if you use it wisely. You can go to the next slide. And I'm not entirely sure if the teams have 401ks set up. They might. I haven't
It's
seen
a team
that.
by team thing. So I know I'm with the Rays. We don't.
Mhm.
I don't know if there are any organizations that do. Does anybody know if their org does?
The Rockies do have a 401k. I think they match up to 4%. I want to say something like that.
Yeah, I think it's 3 or 4% they match through Empower.
When I was with
Okay,
the
well,
Brewers, we had one through Mass Mutual, and the Royals did Principal when I was there.
yeah, so definitely take advantage of these 401k programs. And if the employers are going to match, contribute as much as you guys can to that, because it's basically free money. If your employer is willing to, like, basically add money into your account and let that compound over the next however many years, that's stuff that you guys don't have to put forward, and all you have to do is allocate some of your paycheck to that, which I understand is, like, tough to do, especially like only getting paid, at least before it was like $1,200 a month. It might be a little bit easier this season, since they're raising the pay a little bit. But yeah, take advantage of those 401ks because that's free money from your employers. So 401ks is basically an employer-sponsored account, and it's your free pass to the discount warehouse store of retirement saving. Because you're investing with pre-tax money you haven't yet paid income tax on. So there's more money to invest for compound growth versus an after-tax brokerage account. And an even better perk is that employers may match part of your 401k contribution, a free boost to your retirement savings. You don't want to miss out on that. The rule of thumb is to aim to save 15% of your income for retirement. And I know it sounds like a lot, but the good news is that the 15% goal includes that employer match. So if your employer was matching like up to 4%, then you only need to really take about 11% from your income and put that towards retirement. We'll go to the next slide. So the next slide, this is probably one of the biggest things that I've used for my savings and like the way that I kind of make my paychecks and my savings work. It's to automate your savings. It's perhaps the most powerful one because with every paycheck, you're making progress toward your goals without having to think about it. A one-time setup of automatic direct deposit to your retirement account, an emergency fund, or other goals can lead to a huge payoff. After all, you can't spend the money that you don't see. And why have an emergency fund? Well, because life is full of surprises. And when you set aside money in advance, aiming for at least 3 months worth of expenses, you can handle just about anything that comes your way. So automatic bill payment is also an effective tool that can free up time and credit in your credit score, keep it high. So the way that I do this is like, since we get paid the second and fourth Friday of every month, usually on the day after that, I will make it so automatically some money is sent to, like a portion of that paycheck is going to be sent to a savings account and a portion of that is going to be sent to an investment account. So it's money that like if my salary is actually like $2,000 a month, after using my automatic savings, really I'm only making $1,600 a month. And that's really what I'm going to live off of, because the other 400 is going to be going into investments and savings. So typically what you want to do is you want to have about 3 months of your basic living expenses saved up just in a savings account. And that would just be like in any account that where it's like, this money is very liquid, meaning that I can get the cash out really quickly if I needed to. Because say, for example, like we have like the pandemic and we don't have work for 6 months. Those first 3 months, like instead of panicking, you'll be completely fine because you already have that little savings account set up. So once you get those 3 months set up and set aside, now you can start thinking about putting your money and having it work for you in investments. So basically you just want to make sure that your rent's covered, your utilities are covered, gas, food, insurance. Those are basically like the 5 things that you need to worry about in terms of like overall expenses. We'll go to the next slide. And said, over time, the money you set aside on cruise control for your retirement savings adds up. And that's the power of consistency. And as you can see from the chart, the consistent saver has a leg up on the one that misses 401k contributions. Go next slide. And habit number 6, making money in your sleep, also known as compound returns. Trading your time for money can get you far, but to go further, you must put that money to work by investing, earning returns on the money you invested, and earning returns on those returns. Over time, the balance in the account gains momentum, the snowball effect. Earning compound interest on your savings, nowhere near as powerful as earning compound returns on your investments, as you can see from this line chart. So I'm sure a lot of you guys either heard from your parents or heard at some point in your life to put your money into a savings account and then just kind of leave it there and it will do its thing. That was a good thing like 10 years ago when interest rates were really high, because you could put your money into a savings account and get between 6 and 12%, and you would just leave it there. And like 6 to 12% on your money is really good investments, which is why the stock market was seen like as a scary thing before in the past, because no one really knew like what it was. There was a lot of risk and you couldn't get like the stable returns that you could get in a savings account. But now, and I'm sure you guys have heard that interest rates are like all-time lows. That's why people can borrow so much money to buy like houses at like 2.5% interest rates. Your savings account interest rate is well below 1%. So basically every single day that your money is sitting in savings, it's technically losing value because it's not keeping up with the pace of inflation. So if inflation goes at 1% each year and you're making less than 1% on your money, every single year your money's in that savings account, it's losing value. So that's why having your money in investments and having it work for you is such a powerful thing, because you can stay ahead of inflation and your money can be making you money while you're working on baseball or while you're doing another job or something like that. Okay, next slide. And then the last habit is taking the time to learn investing basics, which is basically what you guys are doing today. And here's a few of them. But if you want to dive deeper, Investopedia and the investment solutions area of raymondjames.com are good places to start. And I'm also going to be available after this to answer some questions. So we'll start with asset allocation. In other words, like the mix of your investments. Asset allocation is the workhorse of investing. It keeps your portfolio aligned with your goals, but most importantly, can limit how the ups and downs of the markets affect your financial plan. You're young, so you have more time than, say, your parents to write out market losses, which is part of the investing experience, as uncomfortable as it might be. But you'll still want to diversify your investment mix to spread out the risk and potentially minimize losses when they do happen. Basically, your asset allocation is the key to controlling your investment experience and the risk you're willing to take on. Within asset allocation are asset classes, like a group of similar investment vehicles like stocks or bonds. A stock is simply a share of ownership in a company, a publicly traded company. When the company goes, hold on one second. Okay. When the company makes money, shareholders profit as well. Bonds, on the other hand, are generally more stable than stocks and represent an IOU of sorts. You lend a corporation, government, or municipality money in the form of a bond, and they promise a fixed rate of return for a certain period of time. So right now, because interest rates are so low, bonds aren't really a good place to have money, because they're relatively safe, but there's not a lot of fixed income options that have attractive interest rates. So it's a safe place to put your money, safer than say like a speculative stock, but you won't be able to access that money like you would in like a bank account or in an individual stock. So your money is a little bit less liquid in that sense. Let me go to the next slide. Here's a quick comparison of stocks and bonds. The comparison here is at its core about the balance between risk and reward. Stocks work like this. A company does well, its stock price goes up, meaning the value of its shares increase. If a company performs poorly, well, the opposite is likely to happen. Stocks can also pay dividends to shareholders. These are regular distributions that are tied to the company performance. Bonds are debt. You're lending money to the entity that issued the bond, with the understanding it will be repaid with interest. Bonds are great stabilizers in a portfolio, but not without risk. There is credit risk, also known as the risk that the borrower won't pay you back in full. But the nature of bonds makes them more stable in general than stocks. So this can be a little bit misleading in terms of like how stocks work. So if companies do well, typically the stock price will go up, but not always. The stock market is really, when it comes down to it, supply and demand. So if a lot of people want to buy a certain stock, that's going to move the price of the company up, because there's a fixed amount of shares that are available to be traded. So if the company does well, a lot of people are going to be flocking to that stock to buy shares of the company. And the people who own the shares of the company don't want to sell that unless they get to a certain price. So that's what's going to move the stock price up. If a company starts doing poorly, people want to sell their shares. And if there's not enough people to buy them, the price of the company will continue to go down. So generally speaking, when a company does well, the price goes up. And generally speaking, when the company does poorly, the price will go down. But it's not exactly like that. That's kind of like where that's where things get a little bit more complicated. And that's where like risk can come in, because you see a company like Tesla continues to go up. And I'm sure you guys have seen how their stock has just continued to like skyrocket to new highs every single day. Nothing is really changing about the company. Like I think today Tesla was up like close to 10%. Nothing changed from yesterday to today. So it can get a little bit sketchy like that. But that's where someone like, when you have a financial advisor and you have a professional who understands the market, understands what you're buying, understands the risks, that's where our help really comes into play. Let me go into the next slide. So how do these various asset classes come together to work to your advantage? Well, over time, most investors expect to receive higher returns for assuming higher risk. But as we've discussed, you know it's a bad idea to put all your eggs in one basket. You manage risk by spreading it out across a variety of stocks, bonds, and other investments. The graph straight line represents the average returns and risk for each asset class type over a 30-year period. Next slide. That said, investing allows you to select the right blend of assets to maximize the potential for returns for the level of risk you are willing to take on, which is why the line can curve, creating an efficient frontier as you diversify and tailor your investments to meet your individual needs. Next slide. So what investment vehicles are available to help you diversify and target a certain amount of returns? So a mutual fund may automatically do that for you, as portfolio managers actively take pooled money from a group of investors and buy a combination of assets, hoping to outperform the market or index. Likewise, an index fund mirrors a particular index like the S&P 500, which tracks the stocks of 500 large companies in the US. It's a very passive way of tracking the broad market. You might also hear about target date funds. Like the name implies, these are mutual funds that actively invest in a diverse portfolio and rebalance the underlying asset allocation over time to align with the target retirement date. Their simplicity makes them popular, but investors who use them need to watch their fees, asset allocation, and investment risk. So basically what's happening here is mutual funds and index funds are, you're basically buying a basket. And in this basket are a bunch of different stocks that a portfolio manager has put into it. So depending on what the portfolio manager thinks, or like what their company sees as like kind of like the outlook for the future, you can buy a piece of this basket without having to spend as much money as buying each individual stock separately. So like, for example, like you see Amazon's like a $3,000 stock, and typically like you have to spend $3,000 to buy one share of Amazon. Or you could buy a mutual fund, say you have like $1,000, and the mutual fund has 10% of their portfolio allocated to Amazon. So when you put $1,000 into this mutual fund, you're going to get 10%. 10% of that $1,000 is going to go towards Amazon shares. So basically you're going to get, what is that, $100 of Amazon. So instead of spending the $3,000 to get Amazon, now you have a little bit of exposure to the price movement of Amazon. So we can go to the next slide.
I have a quick question on that.
Yeah.
So with mutual funds, index funds, and target date funds, you had mentioned with the target date specifically that they change and allocate to different companies. With mutual funds and index funds, do they do similar things where if, 20 years from now, the world is burning and Amazon is like the last stock you want, do they change, or are they kind of stagnant, and do they stay the same?
Yeah, so each mutual fund has different kind of rules, and they'll outline that in what's called a prospectus. Some mutual funds have higher turnovers than others. Some of them have lower turnovers, but it really just depends on each individual fund. So typically the way that I like to look at it is if I'm buying an individual company. So if I was a mutual fund and I'm buying an individual company, I'm not trying to just flip it for a quick profit. I'm buying these companies because I think 5, 10, 20 years down the road, they're still going to be quality companies. Now, let's say like 10 years from now, the reason I bought Amazon Like say if I bought Amazon today because they just have their hand in a little bit of everything, and 10 years from now, Amazon's been kind of like highly regulated. They've been broken up because they're gotten too big and they're basically not able to do what they were able to do today. Then maybe it would be time to start thinking about changing my investment and not keeping my money in Amazon. And that's what these mutual funds do really well, is that they're the professionals. They're the ones who spend every single day studying these companies, studying the market, and they know when to move money in and out. So it really just depends on what kind of risk you're willing to take, because there's some mutual funds that don't change their investments. Typically, they call those unit investment trusts, and they have like a fixed time period, like 2 to 5 years, and they'll put the money into those stocks. They won't touch them, and then in 2 years, they'll pay out whatever it's worth. So those have lower fees because there's less management. But with the actively traded mutual funds, there's higher fees because there's people doing a little bit more work. So I don't know, did that answer your question?
Yeah, thank you. Appreciate it.
Yeah. Okay, we can go to the next slide. And yeah, so that's basically it. So you save for retirement and other goals. An advisor like me can help you solidify these habits into ways to help create financial independence, build wealth, manage risk, and lower taxes. Before you know it, you'll be on the path to financial success with habits that feel like second nature. The next step is to find a way to integrate these habits into your daily life. Yeah. So does anyone have any questions about the topics covered, or just have any other questions?
I should also note that
related
this meeting is intended to be sort of an introduction to a more full financial course, where I think a lot of you guys, because you're here and because you're interested, will be able to sort of dig into more complicated things in that course, credits, how to build your credit score, how to use credit, how to use debt, things like that. And we want this to sort of be an opportunity for you guys to sort of pick Brandon's brain, but also to give us sort of things that we want to put out a little more content about, or provide, future seminars on certain topics. So if there's things that, you're confused about, or you think a lot of guys would be confused about, that's really helpful for us on our end.
Yeah, I think something that might be good is if everyone either like send in one or two things that they would want to see covered in this financial like course that we're doing, like individual questions or like individual topics, and we can go through those. I know probably the biggest ones that we should cover are like credit and credit cards and like building credit. I know that's a big one. I personally started building my credit when I turned 18. There's ways that you can continue to build your credit like kind of automatically and not really have to think about it. Like one way that I do it is like I have credit cards that give me 5% back on my gas, and I know I'm going to be buying gas like every single month, and that credit card just gets paid automatically out of my checking account. So it's something I'm already buying, and I get basically a 5% discount every single time I buy gas. And then by paying my credit card bill on time in full every single month, that builds my credit and can get you from like a 600 to an 800 in a matter of like 1 or 2 years.
One thing I think would be a good topic to address, where I had a lot of questions about coming out of college, less so now, but I still am curious about it, is just like the whole process of taxes, write-offs, like capital gains taxes, filing your taxes, just kind of the more specifics to it. So if you're not just giving it to a financial advisor, if you were trying to do it yourself, you could kind of maybe not be an expert on it, but at least understand the basics of the ins and outs of it.
Mm-hmm.
Does that make sense?
Yeah, we can go into more detail with that. I personally can't give tax advice because I'm not a CPA, and I know you hear that all the time, but like you just can't do it. But I know that there's ways that you can think about when you should sell stuff, if you should buy stuff closer to the end of the year, that can kind of change your tax liability that you're going to have. And there's like good ways to minimize your tax liability through like a traditional IRA, which allows you to write off your contribution to the traditional IRA, and you won't have to pay taxes on that this year. There's also some like backdoor ways to like make sure that you don't have to pay as many taxes, which is kind of like, I don't know if you guys followed like how Trump didn't pay much in income taxes, and yeah, it's because he showed his businesses lost a lot of money, and in reality, like they didn't lose that much money, but he was able to write off like everything because the tax code allows for it. There's actually some really good info on TikTok on taxes, which is kind of funny to think about, but there's some people on there who actually know what they're talking about and give some pretty interesting insight. Yeah, anyone else have any other questions? Individual companies or more about like what I do or different types of accounts?
How long do you think Tesla is going to stay inflated?
I personally will not be buying shares of Tesla, but that's kind of like how it goes back to like, just because a company stock continues to go up doesn't mean the company is doing better. The thing is with Tesla,
they're valued as much as the next 10 auto companies combined, which is crazy.
Yeah, I think if there ever is a tech bubble, that Tesla would be leading the charge into popping that bubble.
Seriously.
Yeah. With the thing with Tesla is that like all of the people who are early investors are like very, very like bullish on Tesla, meaning like they really think that Tesla will continue to go forever, which also means like these people are never going to sell their shares.
No.
They're just going to continue to hold on to it and like continue to drive the stock price up. If you're able
it's
to
like a cult almost.
Oh yeah, it's definitely a cult. There's a few companies that are cult stocks like that. But
a lot
I
of
think,
the
I think
altcoins are too.
Yeah, exactly. I think there's a lot better places for your money with a little bit less risk and a little bit more upside than Tesla. But it's also cool just to say that you own a piece of Tesla.
Yeah, it's true. That's the allure.
Mm-hmm.
Yeah, let's talk Bitcoin real quick for the people who are going to be watching this, so I can clip this for an Instagram video. So like for Bitcoin, I mean, in terms of your thoughts on, as a financial advisor on something like Bitcoin or something like those other, the coins that are out there, currencies, other things like that. What are your thoughts on that?
Yeah. So with Raymond James, we can't buy or sell Bitcoin like just through us, but I do have some insight on Bitcoin. Kind of the idea behind it is Bitcoin is just like, it's this arbitrary thing that people get when they solve problems. And the problems are created on this network, that's where the blockchain is. So blockchain is basically this network of people all trying to solve this problem. And if someone can solve the problem, it'll send it to everyone else on the network to verify that the problem was solved correctly. And then when it's done, the person who solved it gets a Bitcoin. It's like, congrats, you get a Bitcoin. In terms of why the Bitcoin price is going up so much right now is because the theory behind it is that Bitcoin is going to become a better store of value than gold for the future. So gold right now, the price goes up just based on supply and demand. And people will continue to mine gold over the next however many years until gold stops existing, which I don't think will ever happen. And the market cap of gold is well into the trillions of dollars. Bitcoin now is at like a $700 billion market cap, meaning that the amount of Bitcoin that's available is worth $700 billion. When Bitcoin is no longer allowed to be mined, I don't know if you guys remember from like college economics or high school economics, there's like the supply and demand chart. And as like supply increases, demand has to they have to change to like get to an equilibrium price. So now if supply is going to be fixed, the only thing that's going to change is demand. So the demand will continue to move along the supply line because eventually they're going to stop mining Bitcoins. And there's only going to be a set amount of Bitcoins forever. So that's really where this like store of value is coming in, where it would be a good alternative to gold, because gold is like something that your parents and your grandparents bought as like a safe place to put your money. And now like younger people and millennials are buying Bitcoin as a place that's like a safe place to store your money. And so personally, with like the way that I invest is I find ways to tap into what the millennials and like Gen X and Gen Z are going to be buying and using 20 years down the road. Because right now we don't have money. Like we don't have money to spend on stuff. All our parents and our grandparents, they have all the money to spend on stuff. So as we get older and we get more money and more purchasing power, where are we going to be spending our money? And I think a good place to think of in terms of like storing wealth and a store of value for your money, that's kind of like the idea of like why Bitcoin is going up so much. So when people say like, I could see Bitcoin going to 150,000, 500,000, a million, some of it makes a little bit of sense if it's going to be an actual replacement of gold. I don't know if that would be like where I would put all my money. Typically for like, for gold, you want to keep less than 5% of your net worth in gold. So if you like were to take a big picture look of like everything that you have, in terms of your net worth, I would keep it between like 2 and 3% of your net worth and put that in Bitcoin maybe. But I wouldn't be like one of those, like I'm putting my full life savings into Bitcoin because it's going to a million. It could, like, there's no one saying that it's not going to do that because it's just supply and demand. But that's where diversification comes in. Because if Bitcoin doesn't go to a million, it goes back to 20,000, and you put your money in today, half your money is going to be gone. And you're going to be like, well, now what do I do? So.
Awesome. Well, if anybody has any other, go for it.
I was just going to say the altcoins are interesting too. Really the best way that I think there is to track cryptocurrency is there's a fund called Bitwise. I don't know if you guys can actually buy it. It's like, because it trades over the counter, so it's like super risky. But it tracks the market cap of the top 10 cryptocurrencies, and the ticker symbol is BITW. It's a little bit overpriced right now, but that is like, I'm waiting over like the next year. If I'm going to ever buy cryptocurrency and have any kind of access to it, that would probably be the way that I did it.
Cool. Any of you guys have any other questions? We can take a couple of minutes now, or we can just adjourn whenever. But you know, if you guys are interested, we're going to have one-on-one meetings with Brandon over the next week. Megan just sent a link in the chat. If you guys want to take some time and meet with Brandon one-on-one, ask some more questions. If any of you guys are also interested, we'll have a full-length course. It'll be like a 4-week in-depth crash course on financial guidance. That'll be starting in a couple of weeks. Prerequisite is actually having a meeting with Brandon and talking through that stuff. But if you guys are interested, fill out that link. You can send it along to friends and whoever might be interested as well. We're looking for the best way to provide information to minor league players, and to do so in a way that's digestible, in a way that's a little bit better than what MLB has been doing with their like a head in the count program and things like that. So if you guys have suggestions, questions, whatever, shoot me a message, shoot Brandon a message, fill out that form. But appreciate you guys spending some time out of your day with us, and whatever, floor is yours if you guys want to spend some more time on this.
I'll stick.
Oh, you go ahead. Go ahead.
I was just going to say, I'll stick on the call for like 10, 15 minutes if that's okay. And then if you guys have questions, you can ask me individually or to the group.
Okay. Well, my question was just personally for you, just because I was curious about something. You said you're playing minor league baseball right now too, right?
Yeah.
So I forget what the company you said hired you as a financial advisor, but if the minor league season were to start, say April or May,
Mhm.
once the season starts, are you still able to work with that company, or do you kind of take a break for a period of time?
No, I'll be able to work with the company and do everything. It was actually something that worked out really well because I'm not on salary with the company. I'm basically like my own company myself. Like I just work underneath Raymond James. But like you guys know, like when you go to the field, like you show up for a 7 o'clock game, you show up maybe at noon, you sit around for an hour, go to BP, sit around for another 2 hours, do whatever, and then play the game. And then a lot of the time you're just spent on the road. And the great thing about this job is that I've been able to manage my own investments while playing. And a lot of the things that I buy for my clients and recommend to people is also stuff that I would be personally buying. So as long as I'm managing my portfolio, it's a little bit more work and a little bit more paperwork to manage other people's portfolios. But in like the grand scheme of things, it's not like I'm watching the stock market every minute of the day. Like I can spend an hour on this call. I mean, the markets are closed now, but I could theoretically spend an hour not looking at the markets and still feel confident with my investments because I did all the research on the front end of what I was buying and knowing that I'm buying this for 5-10 years down the road. So if that answers your question.
Yeah, I got you. I was just curious because I don't know. I was just interested in that this off season, thinking about applying for a job or not at some point. But if I did, I would want it to be something that I could do during the season. But I just really think it was doable, so kind of wrote it off. So I was just curious, but very cool.
Yeah, I was shocked that I found a job like this that would work for during the season. Because as long as I have a laptop and internet, I can do the job. So, which is cool.
Awesome. Well, we'll call it there, guys. If you guys have other questions, Brandon is available. His email address, I believe, is in his Zoom name, but we'll put it in the chat too. Feel free to reach out. We're here for you guys. Obviously, more than baseball, you guys are all aware of what we do, and thankful for you guys getting involved. Appreciate everything, and have a good weekend.
Thanks, guys.
Thank you, guys.